Now I would request Archer to walk us through the other two methods, which are the transactional profit methods, TNMM and profit split method.
Thank you, Peha. So moving on to the next slide. Yeah. So here we're going to be discussing about the transactional profit split method. So this transactional profit split method is normally used in the scenarios where we have a multiple international transactions which are undertaken by within the related parties, and those transactions are so closely interlinked that they cannot be evaluated separately for determining the arm's length price. The arm's length price is a price that we need to determine under the transfer pricing provisions. These are also used in scenarios where the parties to these controlled transactions owns valuable and non-routine intangible assets. So here, under these scenarios where we have multiple international transactions, which are very closely interlinked, they cannot be evaluated separately. Plus, the parties to these transactions, they own the non-routine intangible assets. So we apply the profit split method. Under the profit split method, now what we need to do is first, we need to identify that what is the combined profit or a loss of the group, which will be split between these entities who are undertaking these international transactions or intercompany transactions. So for this, to apportion this combined profit or loss, we need to follow two method approach. I mean, there are two methods which are given. So first is the contribution split method, and second is the residual profit split method. Under the contribution split method, we see that what is the profit from the controlled transaction, that the combined profit or loss. Now that profit will be split to the each related party, which is based on the functions performed, assets used, or the risk assumed by the each party undertaking or performing that transaction. So this is basically with reference to the arm's length scenario. So that is, in contribution analysis, we allocate the profit or loss, which is the combined profit or loss, based on the relative contribution, and that relative contribution is determined based on the functions, asset, and the risk analysis. Coming to the second method, which is the residual profit split method. Here, we follow the two-stage process. In the stage one, we allocate the combined profit like we did in the contribution analysis. We take the combined profit and then we appropriate that profit to the entities for the routine functions that they have performed to each party of the transaction. Once we have allocated that routine profit based on the routine functions that each party has performed in that transaction, then whatever is the leftover, which is stage two, that is the residual profit. That residual profit or loss is allocated to the parties based on the facts and circumstances that indicate that how this residual profit or loss would be divided between an independent enterprises. In stage two, which is while allocating the residual profit, we focus more on the intangible property which is contributed while undertaking this transaction, relative bargaining power of each party to the transaction, and also the reference is made to the external market data. We can better understand this.
Yeah. I think that for everyone, the profit split method is used very sparingly.
Yes,
and in
correct.
Complex transaction. So for interest of everyone, let's move on to the transaction net margin method, which is very popular and used in Dubai as well as in Middle East region. We have seen that usage much more. So we can move to the transaction net margin method.
So like Amit has clearly, said, very rightly said that profit split method is a very complex method and it's very rarely used. Now we are talking about the method, which is the transactional net margin method. In comparison, it is the most widely used method because it's very easy to use. And we'll also see some of the features which explains that why this method is very widely used method. So under the transactional net margin method, the standard of comparability is less stringent relative to the other methods. So here we only need to compare the broad similarity of the functions performed. So like Piha explained earlier, the cup method, where we need to compare the prices, right? Where we are selling, Apple iPhones. So there, because we are comparing the prices, the product similarity or the product, comparability is very stringent vis-a-vis in the TNMM method, which is the transactional net margin method. Here, the comparison or the comparability criteria is less stringent because we only compare the broad level of functions performed in the controlled transaction vis-a-vis the uncontrolled transaction. Now, what do we compare in this method? So in this method, we compare the net profit margin. So we compare the net profit margin, which is computed, relative to the appropriate base, which is either cost, sale, or an asset, which is realized from a specific controlled transaction vis-a-vis the similar uncontrolled transaction. So for example, if we look at the example given on the slide here, we see enterprise A and enterprise B. So enterprise A is selling the goods to enterprise B, and enterprise A and B are related party. So for this sale of goods, there is a transfer price. So this is a controlled transaction. We see another, which is enterprise C. Here also enterprise C is selling goods to the third party. Now this is an uncontrolled transaction because enterprise C is selling goods to the third party. They are two unrelated parties to each other. So this is an arm's length price. So under the TNMM method, what we compare is, we see that what is the net profit that the enterprise A earns by selling goods to enterprise B. Once we arrive at that net profit margin, we compare it with the net profit margin that enterprise C would have earned by selling the similar goods, performing the similar functions on a broad comparability level to the third party. So this comparison of net profit margin between the controlled transaction between enterprise A and B vis-a-vis the uncontrolled transaction, which is between enterprise C and third party, is basically covered under the transactional net margin method. Can move on to the next slide and explain it. Yeah. So if we take an illustration here, so we see, like I said, so if we look at the left-hand side of the slide, which is we are computing the net margin method, net profit margin based on cost of the tested party. So this left-hand side is the controlled transaction, wherein we are computing the net profit margin of enterprise B. So we see the operating revenue is 100. Then we see that what is the cost incurred by that party in performing that function, which is the selling of goods. So the cost here is 90. And then we arrived in an operating profit, which is a net operating profit, that is 10. And net profit divided by cost. If we see the relative base, here is the cost. Because why it is cost? Why it is not revenue? Because we have seen in the earlier slide, the enterprise B was selling goods. So if it is selling goods, that means in return, it is receiving a revenue. So here, when we compute the net profit margin to a relative base, that base needs to be an uncontrolled. That needs to be an untainted. But in the scenario of the controlled transaction, we are receiving a revenue from the related party, which is a tainted. So we need to consider a relative base, which is uncontrolled. So here, the cost is uncontrolled. So we compute net profit divided by operating cost. and our profit margin of the tested party under the control transaction is 11.11%. Now, when we see an uncontrolled scenario, that is, we will compute the net profit margin of the comparable companies. Okay, like in the earlier slide, we were looking at enterprise C selling the similar goods, performing the similar functions, assuming the similar risk on a broad level of comparability to the third party. So here, and in the previous slide, enterprise C was an uncontrolled transaction, was a comparable company. So, in this method, we need to do a detailed search, which we will explain in the subsequent slides. And then we arrive at comparable companies. So here, company A, B, C, D, E, F are the comparable companies to the tested party. We compute the net operating profit margin based on cost, considering the similar profit level indicator. And then we arrive at an interquartile range, which is 25th percentile to 75th percentile. While in the UAE law, TP law, as of now, the range has not been given, but OECD and other countries usually follow 25th to 75th percentile as a range. So the range here is...
I'll explain here. I'm so sorry to interrupt you. What we are trying to say here is, we do a search on the database, and the database tells us that for a distribution service, someone who is a trading entity, the independent companies in Dubai are earning between 25 to 75 is 6% to 11%. So if my margin, I as a taxpayer, my margin falls between 6 to 11%, that is, if I am at 10%, all my transactions which are justified using TNMM method are as per arm's length price. But this range 25 to 75 is not yet notified. Whatever that range will be notified, if you fall within that range, then all your transactions which of the company which are justified using TNMM will be considered to be compliant with transfer pricing norms. Over to you, Anchal.
Yeah, so absolutely correct. So just to conclude, like Amit just said, we look at 25th and 75th percentile in this example here. It is 8.64 to 13.05%. And the margin of the tested party, which is the control transaction, is 11.11%. Now, since the tested party margin, which is 11.11%, falls within this range of 8.64 to 13.05, hence we can conclude that the transaction is at arm's length from the transfer pricing perspective. So this completes the 5 methods which are given by the UAE TP law, which is in line with the OECD guidelines. In addition to that, the UAE guidelines also provides that we can use any other method also apart from these 5 methods, which the details of which has not been provided yet. In the next slide, we are summarizing all the 5 methods. Sorry, yeah, we have one more slide. This, I think we've already discussed in detail about the transactional net margin method, that what are the key features of this method, because of which it is widely used. So one, the standard of comparability are very less stringent because you are comparing the functions, you're not comparing the products. So this is one of the main advantage. Then we compute the net margin so that net profit margins are relatively less affected by transactional differences vis-a-vis the prices that we compare in cup method, and net margins are more tolerant to some of the functional differences. So these are some of the key features of transactional net margin methods, because of which it is widely used and accepted by the industry. So now moving on next here, we've just given a very brief about, how do we apply transactional net margin method? What are the steps that we need to follow? So in summary, first of all, we identify that what is the nature of international transaction. So like we identified that, sale of goods, probably an enterprise sees a manufacturer. So the sale of goods is the international transaction that it is selling it to its related party. The second step, we will do a functional asset and risk analysis, where we will see that what are the functions that are performed by the enterprise A in the above case, who is selling goods to its related party. FAR analysis we will discuss in detail in the subsequent slides. Once we do the FAR analysis, which is functional analysis, asset analysis, and risk analysis of the tested party or the parties to the transaction, then we conclude that, what is the characterization of an entity. So for example, whether that enterprise A is a full-fledged manufacturer or is a routine manufacturer or is an entrepreneur, so based on the level of or the intensity of functions and the risk, we will characterize the entities. And then we will select the tested party. Tested party has to be the least complex out of the two parties. We will select the most appropriate method, which in this case is the transactional net margin method. We will select the PLI, which is a profit level indicator, like we did net margin divided by operating profit divided by operating cost. Then we do a detailed economic analysis, which includes undertaking a search process on the transfer pricing database to arrive at a set of comparable companies, like we had in the earlier slide, company A to F. And then we compute the arm's length range, like we did 25th to 75th percentile in the above example.
Okay, great, Anshul, great. I think everyone would have seen that transfer pricing is relatively complicated. In fact, when you talk of using the method, you have to choose the method, then you have to do a detailed analysis and demonstrate this analysis in a document to maybe say that when you are dealing with your related parties or connected person, that transaction is as per the market price or the arm's length price. Now, to summarize the different 5 methods which Anchal has discussed, we have the cup method, where you need to compare the two prices apple to apple, which means when you're comparing the prices in case of a cup method, there is very high degree of similarity. So you can compare an iPhone 14 Pro Max with only an iPhone 14 Pro Max. You can't compare with an iPhone 10. And this is applicable for transactions including loans or transactions including transfer of commodity, like you are dealing with petroleum products of grade 14, so you use cup method to compare the prices of petroleum products grade 14 only. Then comes resale price method. This is very popularly used in trading companies who are doing trading. Here also we have a little bit of flexibility. We can use trading of someone trading in maybe trading of plastics. He can use trading of some different version of plastics, not just grade A, but therefore different version of plastic trading. He can compare the margin when he does trading of plastic grade A with trading of with the gross margin he earns in plastic grade B. So broad level comparability can be there. Cost plus method, we discussed it. It is majorly used for when you're providing services or transfer of semi-finished goods. The profit split method, method number 4, is complex, not used too often, and therefore it is used for intangibles, that is IP transfers or very integrated transactions, not very popular. The TNMM, which is a very popular method here, which Anjal explained in detail, we do a search on the database, find 5 companies, ensure that the margin of you as a company which has related party transaction falls within that range of 6 to 11%. And the taxpayer, when he chooses the methods, he can choose the method depending on the facts of the case. Now, how does he choose? That is determined on the functional analysis, which we'll discuss in the next webinar, and of course, other specific facts of the transaction. We can move to the next slide, which.
Yeah. Now we heard about the different methods which can be used. Now let us also understand what are the documentations required as per law. Article 55 of the law says that each company needs to keep local file as well as master file. So with the introduction of the terms local file or requirements of local file and master file, UAE is aligning itself to the three-tier documentation approach of the OECD. Let us see what are the three-tier documentation approach of OECD. The first one is to have a disclosure form which contains information regarding their transaction with the related parties and connected persons, and this ideally needs to be filed along with the tax return. In UAE, actually, they have not mentioned about a filing of this disclosure form, but what they say is that along with the return, we need to make adjustments for transfer pricing. This is what the law has currently mentioned. We need to wait for cabinet decisions to get full clarity whether we need to submit this form or not. Then the second requirement is to maintain master file and local file, which is included already in the UAE Corporate Tax Law. But the thresholds and conditions for the applicability are yet to be published. And the third process is that taxable persons need to submit the documentation within 30 days from the date of request from the tax authority or such a later date as may be directed by the authority. So this master file and local file, there is no requirement to submit this one unless authority asks for that one. But the catch is that this needs to be submitted within 30 days from the date of request by the tax authority. So at any point of the time, they can come and ask for this document. So for all companies should be ready with these documents. And see, as I said, UAE law has not published more details about the contents of master file and local file, but let us analyze from the point of view of OECD guidelines. As per the OECD guidelines, a master file should provide an overview of M&A Group's business, including the nature of its global business operations, its overall transfer pricing, etc. Ideally, the informations to be documented in the master file include the organization structure, description of M&A Group's businesses, M&A Group's intangibles, M&A Group's intercompany financial activity, M&A Group's financial and tax provisions, etc. Okay, if you have a M&E and parent companies outside UAE, like in India or Europe, already they will be having this master file content for their requirements in other jurisdictions. So it may be ready with your parent companies, but local file content, the local file provides more detailed information relating to specific intercompany transactions pertaining to a particular jurisdiction. So local file is more important from UAE point of view. And the important informations which should be included in local file are details of related party transactions, an overview of the group, an overview of the industry in which you work, the functional assets and risk analysis. This is more critical, and an economic analysis. Okay, and again, to navigate through the requirements of this local file and master file, let me hand over to the expert team. Hello,
Sorry, I was
Anshul?
on mute. Yeah, I was on mute. Sorry. So very right, GB, you said the local file is something, the first point of information that is asked by the tax authority. In the decree that is being issued by the Dubai Financial Authority, it says that you are required to first file the list of all the transactions with your tax, with your connected person with related party transaction. That's the first thing. So now they will know, the authority will know, okay, these are the 10 people with which your company has entered into the related party transaction and connected person. Then they will then ask any time that you furnish the local file within 30 days when they request. And after you furnish the local file, they can again ask for backup documentation or backup questions as to why did you, when you do your local file, a lot of data is given. So they can question the data, the source of the data. That is in point 3, backup documentation for justifying the arm's length price. Now, in my experience, local file is considered as the first point of analysis even in India or developed locations, master file you can take from your group companies if master file is applicable to you. So if I move to the next slide, and it is already covered by GV, I'll not take time here. The group overview, functional analysis, economic analysis, and industry overview is required for your transfer pricing local file. Next slide. What is group overview? So group overview is a very basic overview of the group. What does your group structure look like? With whom you have done your related party transaction or connected party transaction. But after the group overview, then comes the detailed part, which is the functional analysis. Aanchal will help you with the functional analysis, which is the most important part here when you're doing your transfer pricing in the local file. You're talking of the local file.
Yeah. So like Amit rightly said that FAR analysis, which is, the functional asset and risk analysis, is very critical part of the local file, which is the transfer pricing documentation. So what do you mean by FAR analysis? So basically it's an exercise where we first understand, analyze, and then we document in the local file, the transfer pricing report itself, that what are the functions performed, what are the risks assumed, and what are the assets employed or to be employed by the taxpayer, which is by you and your related party or connected person, which is involved in the intercompany transaction. So if there is an intercompany transaction, say for provision of services by enterprise A to enterprise B, and both of them are related party or connected person, then we need to understand, analyze, and document that what are the functions which are performed by enterprise A in providing those services, and what are the functions performed by enterprise B in receiving those services. So this means this is the functional analysis. Now, how does this help? This helps us to map that what are the roles, what are the responsibilities, and what are the risks assumed by each of the party which are transacting for this international transaction. That, what is the role and responsibility of enterprise A, and what are the roles and responsibility of enterprise B. Now, based on these roles and responsibilities, we will characterize the entity, that what is the characterization of the enterprise A and what is the characterization of enterprise B. For instance, like I said that, whether they are, a routine service provider or whether they are an entrepreneur. If they're a routine service provider, they would be performing the routine functions, would be undertaking routine risk. If they're an entrepreneur, they would be performing a full-fledged functions, undertaking a significant risk. Now, based on which the tested party would be selected, that which entity we will consider to do an arm's length analysis, because the tested party needs to be the least complex out of the two parties, enterprise A and enterprise B, which will be determined based on the functions performed and the risk assumed. So if we see that what actually we need to document in the functional analysis, risk analysis, and asset analysis, then in the functional analysis, we need to first understand and document the detail of the international transaction. Like if I'm saying provision of services, then we need to go through the intercompany agreement. We need to go through the invoices, the backup documents, and see that what are the details of the international transaction, that what all includes in the provision of services. So we need to elaborate the nature of activities or the type of services. We also need to see that what are the contractual terms, what are the clauses of that intercompany agreement in relation to that provision of services, or whatever is the international transaction under review. We need to see what is the role of both the company, which is you, and the associate enterprise, which is like the related party or the connected person. What are the geographies they serve, IP in performing those functions. So here the focus is on identification of the critical functions, which adds value to the international transaction. So all this will be analyzed and documented in the local file as a part of a functional analysis. When we talk about asset analysis, here we need to see that what are the nature and what are the value of assets which are employed in the operations, which will determine the contribution to the business process or the economic activity by each entity. So we see that who owns the routine tangible, who owns the intangible assets. So out of the two entity, we also need to see that who owns the IP, or if there is any valuable intangible asset which is used by any of the party in performing the function of provision of services. Because this will again help to facilitate the determination of returns to be earned by them based on the asset used in this transaction. Then lastly, we need to see the risk analysis, that which entity is undertaking how much risk in performing those functions while undertaking the transaction of provision of services. So this needs to be adequately determined and understand. Here again, the focus should be on important risk. For example, who is bearing the market risk, who's bearing the credit risk, contractual risk, foreign exchange risk. Again, if you have more risk, the potential to earn more profit is also there. So risk analysis is equally important. So this is in brief the functional asset and risk analysis, which needs to be undertaken in detail for both the parties to the transaction.
So in the